Here is a question worth holding on to for the next few minutes. How does a market give back a record it set only yesterday, take a run of genuinely weak economic data on the chin, and still finish the day calmer than it started? Because that is exactly what happened. The S&P let go of Thursday's record close, slipped back under the 7,800 line it had just reclaimed, and ended lower, by about 1/6%, near the worst level of its afternoon. This is the AlgoIndex market close, Friday the 14th of August, and while the market did all of that, the fear gauge did not rise. It fell, by better than 2.5%, down to 14.25, a stone's throw from its lowest mark of the year. A record given back, weak data absorbed, and less fear at the close than at the open. The number that explains that stillness is not on any chart you had open today, and it is the reason this particular weekend is more dangerous than the calm is letting on. Here is the board in one breath. The S&P lower by about 1/6%, just under 7,786. The Nasdaq 100 a shade softer as its chip leaders did the selling. And that fear gauge down to 14.25. Three things worth staying for, and I will count them down. Third, the one figure that shows the market is pricing almost no movement at all for Monday, and how far below normal it is sitting. Second, the desks that spent the whole session manufacturing that calm, who they were and what they were selling to make it. And first, the one event that crossed the wire this weekend that not a single one of those prices can account for because it landed after the doors were already locked. Stay for the third, and the first is the piece that could undo all of it before you have coffee on Monday. Take the board on its own before the story underneath it. The S&P finished at 7,786, lower by about 1/6%, which erases roughly the front half of Thursday's record run in one session. The Nasdaq 100 slipped a touch more in percentage terms, because its chip leaders were the ones doing the selling. This was a broad, shallow giveback, not a rotation with a winner on the other side. The fear gauge is where the day turned strange. On a session that surrendered a record, it went down, not up, closing at 14.25, lower by better than 2.5%, back near where it spends its quietest weeks. Top to bottom, the S&P covered about 45 basis points, one of the tightest ranges of the month, on a day that had real reasons to be wider. One number on the board did break ranks. The 10-year yield rose into that weak data instead of easing with it. The small stagflationary note under an otherwise placid close. Carry one reading forward, because it is the spine of the whole show. The options market is pricing next to nothing for Monday. Its one-month protection carries a rank near 9%, close to the bottom of the year, and it is priced more than 2 volatility points under what the market is actually delivering day to day. Now the mechanism, because a record does not slip away by accident, and a hard miss does not produce a small day by accident either. Start with what hit the wire. Retail sales fell 0.6% in the morning when the street was looking for a small gain, and at 10 o'clock, consumer sentiment collapsed to 51 from the mid-50s. That is a genuinely soft morning of data, and it moved the S&P about 13 points. The reason it moved so little is the flow. The live dealer hedging read closed the session about $4 billion net negative, and once you break it open, close to $5 billion of that was same-day call selling, with barely $1 billion leaning the other way. The desks were not placing a direction. They were stripping premium out of options set to expire into the bell, cashing the last of the week's volatility on their way into a long weekend. That selling is the hand that pressed the range flat. And it worked because of where price sits in the dealer's book. The close at 7,786 sits a full 149 points above the level where dealer positioning would flip its sign, which keeps the entire environment in its dampening setting. In plain terms, the machinery is leaning against moves in both directions, and that is the mechanical reason a soft data morning produced a 45 basis point day. The one place the cushion thins out is right beneath the 7,800 line, and that thin patch is exactly why the midday slide, once the market lost the ceiling, traveled straight down to the pivot band before it found a bid. The names lined up with a weak day. Leadership, such as it was, ran in reverse. The heaviest weights were the chip makers, 2 large equipment and design names down 5 to 6%, and they dragged the Nasdaq under with them. The one corner that firmed was energy, and it firmed for a reason I am saving for the very end. Put Friday on the chart, and it reads as a give back in 3 moves. It opened firm, gapping up towards 7,808, still carrying Thursday's momentum, and it reached for the record one more time, but never reclaimed the all-time high it set Thursday, 7,816. That is move 1, the failure to extend. Move 2 was the middle of the day. Once the 7,800 line gave way, the drop had almost nothing to catch it through that thin patch of dealer cushion, and it fell straight to the pivot band in the mid-7,700s. Move 3 was the base. The deep support down around 7,776 held on 3 separate tests, and the market closed just above it at 7,786, sitting right on the dealer pivot rather than under it. So tomorrow's map is short and clean. Overhead, 7,800 is the line it has to climb back over. Then Thursday's high at 7,816. Underneath, 7,775 is the pivot to hold. Then the 6-way shelf at 7,752. The single number that matters at the open is 7,775. Hold it, and Friday was a pause. Lose it, and the give back has a second leg. Most nights, this is where I hand you the single biggest bet a desk placed on one stock. Friday did not have one. With the technology earnings calendar empty, and single name volatility reset to its lowest of the year, no single name stood up and swung. The loudest position of the day was not a ticket at all. It was a posture, and the whole dealer community put it on at once. Sell the weekend's volatility. That $5 billion of same-day call selling was not a view on direction. It was a decision to pull premium off the table ahead of 2 closed days. And it is why Monday now opens priced for almost nothing. 3 sessions ago, from this same seat, the story was the opposite trade. Those desks were buying the cheapest 1-month downside cover of the entire year, stacking protection into the inflation print. Friday, staring at a long weekend, they turned around and sold volatility instead. Same desks, opposite instinct, 48 hours apart. When the people whose whole job is to price risk decide the next 2 days are worth almost nothing, that is a statement. And the next segment is about whether they have it right. Here is the reading the whole show has been walking toward. Put a number on how little Monday is priced to move. The at-the-money volatility on the index for Monday is sitting near 5%, among the most depressed prints in months, and the options implied one-day move works out to about 58 points, 0.75%. That is the market betting the next session is a non-event, but the cheapness is lopsided, and the shape of it is the whole tell. While the index option overall is marked down, with its rank near 9%, the extra premium the market charges for downside cover over upside is parked near the 98th percentile of its entire year. So the crowd is doing 2 things in the same breath, pricing almost no movement and paying near the top of its year for the specific protection that only pays if it is wrong. That is not a market that believes its own calm. It is pricing the next session as nothing while quietly overpaying for the way out of it. Owning protection here is inexpensive in absolute dollars, and the crowd already agrees it is the side to own. Selling volatility into this pays almost nothing. And the reason both of those matter more than usual tonight is a single item on the calendar that not one of these prices includes. The desk kept it small, and the result was 1 trade, 1 win, no losses, flat into the weekend. The single position was a long call taken off that deep support base once it had held 3 times, down around 7,776 and closed for a small gain, $11 on the contract. When the reclaim back over 7,795 failed to develop, and the flow stayed net negative. Small, but on the right side, and taken at a location that had already proven itself, rather than one we guessed at. The part that never shows up as a number was the morning. As price rolled off the highs and lost the 7,800 line, the drop set up a tempting long, 3 separate times. And 3 separate times the rule held. No long into a level until it is reclaimed, not while the hedging flow underneath it is still making fresh lows. The automated brackets we staged before the open never filled, and because nothing filled, there is no card and nothing to invent. 1 clean win, 3 chases refused, and a book carrying 0 risk into a weekend that has plenty of it. That is the trade tonight. Before the road ahead, let me settle up on yesterday's read, because a call from this seat is only worth anything if I come back and check it. A day ago, the message here was constructive, but capped. Hold 7,800 to keep the record alive, lose the lower shelf, and the session tilts defensive. Here's how it played. The market did not hold 7,800. The reclaim it printed on Thursday gave straight back on Friday, so the capped half of that message is the half that paid, and the defensive tilt is the one to carry into next week. Now the map into Monday, and the conviction is low on purpose. The uptrend is intact. Price sits well above the level where the dealer's book would turn against it, and the positioning desks are still looking a few days out, towards 7,900 and beyond. Against all of that, Friday closed as a failed high near its low, the 10-year yield rose into weak data, the chip leaders sold off, and the calendar is thin on Monday, with no large earnings until the retail names start Tuesday. So buy the 7,775 pivot band while it holds, look for a rotation back towards 7,799, and then 7,822, and treat acceptance below 77.75 as the signal the map has turned lower, toward the 7,752 shelf. And the part tonight cannot settle for you, which is the whole reason the low volatility should make you sit up rather than relax. After the closing bell, with the futures market already shut until Sunday evening, the geopolitical picture escalated hard. The president described a maritime blockade of Iran and floated declaring the Strait of Hormuz United States territory. And within the hour, Iran answered that the strait opens or closes under its authority and no one else's. Crude closed up about 1.5% on it, at 82.40. And that is the quarter of the market that firmed today. None of that rhetoric sits in a single price you can see tonight, because there are 49 hours between the Friday close and the Sunday reopen. And Monday's volatility is priced for a quiet event. What would flip the constructive read is simple to watch for: a sharp gap in crude or the yen, when futures reopen Sunday at 6. If that gap does not come, the dip buy is live. A few things before the weekend. First, the AlgoIndex trading journal is free to start at members.algoindex.com/auth/signup, and it scores every trade you log against the exact price your screen showed the instant you pulled the trigger. So the record marks itself, and not you. Second, if you want to see how the dealer levels we post each evening actually behave, whether they held or gave way, that scorecard stays open to everyone at algoindex.com/tools/gamma level accuracy. Third, if you would rather read it, the full write-up of tonight is at algoindex.com/blog. And the traders who pull these calls apart live through the week gather on Discord, invitation only. Watch the Sunday evening reopen, keep one eye on crude, and I will be back after Monday's close to tell you whether the quiet held.